89.9.
BFM 89.9. Good afternoon. I'm Roshan Kannison and welcome to Enterprise Explores, the show where we help you navigate the ever-changing universe of business from the headlines to the bottom line. The world seems to be watching as the U.S. Federal Reserve faces increasingly intense political pressure. President Donald Trump is, among other things, pushing for the Fed to slash its benchmark interest rate, claiming it's costing the country, and I quote, hundreds of billions of dollars by not cutting. Now, this focus on interest costs comes amidst escalating national debt. The U.S. spent $1.1 trillion in interest on its debt in 2024, and President Trump recently signed the One Big Beautiful Bill expected to add over $3 trillion to the deficit in the next decade. Consequently, Moody's relatedly, Moody's recently downgraded U.S. debt in May, citing the increase in government debt and interest payment ratios as a concern. On top of that, with the U.S. currently healthy and inflation above target, forcing a cut could reignite inflation, which is a core concern as well. Recently, JP Morgan CEO Jamie Dimon warned playing around with the Fed could have adverse consequences, among which include jeopardizing investor trust. So, with all said and done, what are the core dangers here of an artificially low Fed rate to the U.S., but also globally? To dissect these concerns and more, we have on the line with us Economist Dr. Carmelo Ferlito, CEO of the Center for Market Education. Carmelo, good to see you again. How are you doing?
Hi, all well. Thanks for having me on this stimulating topic.
Once again, a focus on central banks. I'm sure you must be excited.
Yes, absolutely.
So, Carmelo, as has been reported multiple times over the last week or so, Trump wants to cut rates to 1% over in the U.S. What's the core problem here with this?
Well, obviously, we can say, and this is the most common interpretation, is that pushing down interest rates at that level, in particular in the current circumstances, will first and foremost reignite inflationary pressures in a moment in which that is not really necessary. But my position tends to be more radical than that. And, I tend to believe that prices, all kind of prices, exercise their allocation resource function when they arise from the free interaction between supply and demand. So any central interference on the price mechanism, may it from the political authority or from the monetary authority, doesn't matter, tends to make damage to that kind of function, a coordination function that prices exercise. And in fact, I do believe that something like a centrally determined interest rate should not exist at all, because there are several interest rates. There is no reason to believe, in example, that a coordinating interest rate between savers and investors, so those that put funds on a bank and those that require funds from a bank, should be the same or should guide it by the same signal like the interest rate that is emerging from the bond market, in example. These are different markets responding to different logics and therefore guided by different prices.
And of course, this is something we covered a few weeks back in a podcast titled Are Central Banks Inadvertently Causing Economic Crises? If you want to learn more about that or dive into that topic, you know where to go, BFM app or bfm.my, and just search for central banks, and I'm sure you'll find that conversation. So when we come back to this topic today, Carmelo, usually this level is perceived when we cut rates to 1%, is usually perceived as a crisis response and not sign of economic health. Could you elaborate on this point for us?
Yes, indeed. Let's say the dominant theory, which is practices by central banks, tend to see playing, let's say, in a positive sense, with the interest rate to respond to different kind of problems. So traditionally, we say that interest rates are raised when there are inflationary pressure to withdraw money from the economic system, so to cool down the economic system, while indeed when an economic crisis emerges, central monetary authorities tend to lower interest rate, assuming that lower interest rate would stimulate the economic activity because it makes borrowing cheaper. That is the logic behind. Although I tend to believe that profit expectations are a much more important signal than the interest rate, but it's something to dig separately.
But that goes back to your earlier thesis as well about you letting the market kind of decide these different factors. But given the current situation that we have, it's really central banks play a key role in determining that base interest rate. And usually it seems that if an economy is growing and employment is within benchmarks or near full employment, usually you don't want to be messing around with the rates. Why is a so-called 1% rate dangerous in this kind of environment where economies are growing or almost growing and employment is nearly full?
Yeah, when, let's say, resources are at the level of full employment or semi-full employment, so there are no or little unexploited resources and factors, lowering the interest rate basically increase the possibility of increasing the demand for production factors, including labor and others, because cheaper borrowing push for demands for loanable fund, for investment, and being in a moment in which there are little unused resources, then the increased demand will push on the price of those resources, then bringing the prices of that resources upward.
And ultimately, as it stands today, the Fed's mandate largely is to include stabilizing prices, not necessarily making deficits cheaper. So how does this kind of political pressure that we're seeing change the narrative around it, or even make its job more difficult, its mandate more difficult?
So central banks have the mandate of price stability, which is a good mandate. So I think they should remain focused on that target. But unfortunately, as we also have discussed in other occasions, their control on price stability is not full. I mean, is not total. And indeed, political pressures, either in the form of what Trump is asking now, or via extreme fiscal policies, let's say, can take different shapes, play a role on price stability which is much stronger than what the central banks can actually control. And so in this environment, indeed, the risk of resurgent price pressures is very real if the political interference that President Trump wants to play will indeed takes place. And it will be not the first time in history, indeed.
Yeah, and because we have seen obviously this is a very loud occasion given the way the communication is being deployed, but there have been other times, maybe post GFC as well, where central banks have taken very radical positions or extreme positions in that time. One thing that I saw in the news last week was Jamie Dimon, CEO of JP Morgan, also stepped in, and people like to pay attention to what Jamie Dimon likes to say. And he warned against playing around with the Fed. Why is the Fed so key here, whether it's in terms of trust or as a monetary policy trigger? Why do we watch the Fed so closely?
Well, first of all, as you say, this is a very noisy case of political interference, but some time ago I read the biography of Paul Volcker, if you remember, the famous Fed chairman who is hailed because of he cured the so-called inflation of the 1970s. When you go through this biography, you find that indeed the attempt, more or less successful, from politicians to interfere with Fed activity has been very, very much present in the history of the United States from whatever party was in power. So this is a very constant situation that in certain scenarios is more or less noisy. Indeed, central banks are surrounded by this aura of independence, so they are perceived to be independent from political power, and therefore, and these create a sort of trust in the financial system, in the currency that we use, and therefore in the general rule of law that surrounds monetary and financial transactions. So undermining that can undermine this global trust that we have in central banks. Then the fact that this trust is misplaced or not is a matter that can vary from case to case, actually.
And there's also quite a significant delta here, right? Between, I think Fed rates are currently 4.25 to 4.5%. To come out and say, oh, we want to cut to 1% signals a lot of different things out there. When you hear something like that, are there any top-line concerns that come out to you when a president calls out for such a big difference in the interest rate there?
Well, you see, these are clearly signs that, somehow Trump is trying to do a politics that seems to appeal to business people. And also this tells us that being business friendly doesn't necessarily mean to be market friendly. These are two different things, so the distinction, I think, is important to be kept there. I think that as everything regarding Trump, we need to try to distinguish what is a strong announcement pushed there on the table in order to arrive at something else, to a negotiation, to a discussion, to a compromise, and what is, the real outcome later on. We have seen that with tariffs. So we start with a big shout, and then this is just an occasion to bring people at the table and to play cards together. So I honestly don't believe that the central bank will really give in to this request, but probably it would be interesting to understand the real motivation behind this call from President Trump.
Carmelo, we got more to get into, including some concerns over reigniting inflation, but also a look at the market perspective, right? Because as you just said, being business friendly may not always be market friendly. So that's going to be an interesting concept to dive into as well. Folks, this is Enterprise Explorers, the show where we help you navigate the ever-changing universe of business. And today I'm speaking with Economist Dr. Carmelo Ferlito about the U.S. Federal Reserve policy rate and why it's a rate that we watch so closely, and why pushing for 1% rate might be an issue for global markets as well as the U.S. I'm Roshan Kanasan. Keep it here to BFM 89.9, the business station. BFM 89.9, welcome back to Enterprise Explores. I'm Roshan Kanasan, and today I'm speaking with Economist Dr. Carmelo Ferlito, CEO of the Center for Market Education, and we're exploring some of the key concerns associated with a 1% U.S. Fed rate, political pressure on central banks, and of course, their profound implication on financial stability. We're now turning our attention to the concept of economic fallout of artificially low interest rates, including the hidden risks of reignited inflation and compromised investor trust. Carmelo, ultimately at the core of this conversation is whether it's artificially low or artificially high interest rates, these have market implications. We talked about the business-friendly nature of it earlier, But from the market perspective here, how would this de-anchoring from inflation expectations impact bond markets, for example?
Well, you see, this is the point that I was trying to make before, that when prices, whatever prices, are somehow, let's say, generally speaking, politically motivated, then they do not represent anything. So a price, in order to be a price and to be properly called price, need to be the result of interaction between supply and demand. So, as you mentioned, doesn't matter if artificially low, artificially high. The key word here is artificial. So most probably, and not only here is a matter of inflation, but if you look at financial market, I think that the main concern at play, it could become the trust that can be placed on the whole financial system. So I'm afraid that what a 1% interest rate could ignite is a long wave of speculations and potentially asset bubbles, which in the past decades are what really have marked the ongoing of business cycles. We have seen this on the dot-com bubble. We have seen this with real estate in 2008. So the idea that even within a context of price stability, financial imbalances can happen when interest rates are kept artificially low. And later this situation somehow just burst.
We've used the word artificial interest rates a few times now. How do we know if an interest rate is artificial, whether higher or lower?
That's precisely the point. An interest rate would be not artificial if it would be determined by the market and not by any political authority or monetary authority. So it is not a matter of policy, politics or central banks. There has been actually several definitions of natural interest rate along the history of economic thought, and we can't dig into that. But if I were to bring us really through very, very different kind of authors. But I think the point that I want to make here, that what does it mean natural? I mean, I tend to stay away from any definition of equilibrium or balance on supply and demand, but the fact that a price is natural when it's market determined. There is no way for us to know what is the perfect price. And as me and you don't know, no political authority can know. And I think this is really the main point. Allow me to go a little bit philosophical, but the government or the central bank do not exist. These institutions, we use the word for the sake of conversation, but indeed these institutions are made of individuals, of people, made of a governor A, governor B, minister A, minister B. So these are humans, not superhumans. And as such, they cannot determine what an equilibrium or a natural or a just price is. And even St. Thomas Aquinas, that cannot be accused to be a radical libertarian, surely, was saying that indeed the best thing that we can determine as a just price is the price that is determined by supply and demand, when supply and demand are free to interact between themselves without any violence upon them.
Now, one of the key markets, I guess, for these fixed income products out there is the treasury market, which is a sizable market out there. How important or influential is this really?
it is an important market, but I think we should not overestimate its importance. Is one of the speculative market that surely serve as a reference for other markets. But indeed, I would tend to say that there are markets, not one market, and therefore each market has a different dynamic, and the motivations of supply and demands behind that are different. Speculative nature, more strategic investment nature. So in order to understand financial logics and the emergence of real interest rates, I think we should go really micro from market to market.
Now, that's it, Carmelo. Even though central banks can set policy rates for interest rates, ultimately the buyers of government bonds aren't forced to buy them necessarily. So sometimes you may see a larger spread between the rate and the actual yield, right? So is that a way for the market to express, I guess, its confidence in whether, in terms of the credit risk of a particular sovereign debt, or in fact whether interest rates are artificial or not?
Yes, indeed. The point that you made is precisely a market response. Let's not forget that the interest rate that central banks determine is a reference interest rate. So it's not a buy low interest rate that every institution is forced to follow, but is a reference rate that helps other rates to be fixed. But as you rightly mentioned, then what emerged down on the ground in banking activity, in investment activities, is already a signal that where the market intentions are going when compared to the policy direction of central banks.
So is there maybe a sign of confidence by the market itself whether it responds to sale of government debt then?
I think that is not really a matter of confidence, because the price mechanism, the determinants behind there are so different that indeed central banks determine interest rates, reference interest rates for policy reasons, while what emerge in the bond market or in the asset markets or in the credit market respond more to supply and demand, indeed, so to the pure market logic, and the fact that this value may tend to converge tends to be, in my view, more of an accident, let's say, or a coincidence rather than a structural balance between them.
Now, let's go back to your paper, which we discussed a few weeks back, which basically one of the key things that you were advocating for was not having the central bank rates that determine the base policy rate. Then, how do you think this would, abate any, like today's environment today, right? How would not having a central bank rate avoid the noise that we're seeing today and the concerns that come from it?
Well, if we wouldn't have the central bank dictating the reference interest rate, we couldn't have the presidents that asked the central bank to go in that direction, because then the price on the ground will be fully market determined, and so there will be no direct interference that political authority could play in the mechanism of fixation, and therefore would be much more difficult to have inflationary policies like it happens today. In fact, if you look also at economists like Friedrich Hayek, that has been changing position over financial instruments over time, he tended to believe that central banks could play with interest rate in a moderate way to control cycles at a certain extent for a great part of his life. But then after the 1970s, and in particular after the abandonment of the gold exchange standard, he he changed his perspective and advocated for a free competition between currencies in order to have price stability, because then, having abandoned the last natural anchor to price stability, which was gold, then the possibility to inflate for governments is basically without limit.
There's nothing to anchor how much currency you issue, basically.
And that's the proposal of a competition between different currencies, so where governments are allowed to print their own money, private institutions are allowed to do so, and in a certain territory you have the possibility for different currencies to compete for the market favor. And obviously individuals will tend to choose the currency that protect better their purchasing power, and therefore the good money in this case will kick out the bad money. And this would be a natural incentive for governments or money issuers to preserve the value of their currency rather than destabilize it. And this was a trend that emerged in the 1970s in economic thinking, which I think is worth re-exploring in the current scenario.
Now, going back to price stability, which, as you mentioned earlier, you still believe that central banks should be the mandate still. If they didn't have control over, or if interest rates weren't the weapon to use for this, how would they execute upon their mandate for price stability, in your view?
So on one side, the fact that we would have an interest rate market determined would be already a natural barrier to inflation. On the other side, of course, there are other tools that with which the central bank can control the quantity of money into circulation, which is buying or selling bonds, or in example, something that could be introduced is a sort of control power over the possibility of spending of government, so more a bigger role on the control on fiscal policy. These are things that could be thought and conceived in example.
Now, let's take a look at the global landscape here. We've spent a lot of time talking about the U.S. specifically, but how could you elaborate to us how changes in U.S. Fed policy has ripple effects to other currencies and, of course, other markets?
Well, we have seen that Southeast Asia already started with Malaysia and Indonesia to cut interest rate. So there is somehow the perception that something is changing after years of interest rate stability. Obviously, whatever happened in the United States have consequences for everybody. The United States are the biggest world consumer, so the biggest trading partner for our region, and it is important to consider that eventual financial instability there will definitely have bigger consequences all over the world. We have seen this with the most recent crisis in 2008. That was really an American-born phenomenon. The housing market, the speculation there, all the junk financial tools. And when the bubble burst, then nobody escaped from the drama.
And there's this with the changing of interest rates between different nations, does this tie back to what you were talking about in terms of competition for currency?
These are different measures that could be used as a part of a global monetary reform. Again, abolishing central determined interest rate and introducing competition among currencies, between currencies, is not they're not mutually exclusive. Can be part of the same game. Although I recognize that here we are going really into the level of idealistic conversations, and I don't see any practical possibility for these reforms to be implemented. Although from the theoretical perspective, we as scholars, we have the moral obligation to discuss also these alternatives.
And maybe to wrap up our conversation today, Carmelo, whether the Fed increases rates or decreases rates, in this case, it might err towards the lowering of rates. How does this then spill over to capital markets such as Malaysia's?
Well, I think that we have to see mostly which kind of inflationary effect this will have, and then the kind of reaction that local central banks will have, because here we have different forces at play. So we have an effect that an inflationary effect that may be created by the Fed, but on the other side we have central banks here that are lowering the interest rate, expecting a slowdown of the economic activity. So these are conflicting forces, and which trend will emerge as the winning one will determine also what happens on the financial markets and capital markets.
And just final note here, because when, let's say, if the U.S. rates are higher than local rates, there might be capital flows to the U.S. for that safe haven interest rate, right? And so if that lowers, do we expect to see capital flows out into other markets that might have higher rates?
Yes, this is a normal dynamic. Capitals flows in and out for better returns. Although, this obviously can have a repercussion on the local currencies. But these are speculative movements that I think alternate each other over the time of 5 years. We see movements in different directions. So in the medium run, let's say these movements tend to equilibrate themselves and not to have too much influence on the real economy. What really matters is instead the financial imbalance and the consequences on the real economy and so in the real circuit that too low interest rates can have.
Carmelo, always a pleasure speaking with you. Thank you so much for your time.
Thank you. The pleasure was all mine. Thank you very much.
Folks, you've been listening to Enterprise Explores, the show where we help you navigate the ever-changing universe of business from the headlines to the bottom line. And today I was speaking with Dr. Carmelo Ferlito, CEO of the Center for Market Education and economist as well. And we were dissecting the risks of artificially adjusted inflation, artificially adjusted interest rates, whether high or low. And some bits of it, of course, were more idealistic in nature, but nonetheless interesting. If you missed any part of the conversation, go and catch the podcast on our website at bfm.my or download the BFM app later today. Just look for Enterprise Explores. I'm Roshan Kanasan. Keep it here to BFM 89.9, the business station.